market is in turmoil and chaos, and this is such an important conversation.
Remembering how important it is to care about one another in each moment, because we don't know how many we have left.
There's an interesting kind of humorous / bad element here, because I was thinking, well, like if anyone could get a picture of my granny and they either want to sell me something or they want to scam me.
And that all this money business, from our perspective, I think I speak for both of us, is to make more of those moments available to us.
Every day for several days, like my portfolio has been down like way more than my annual salary ever was. And that's like day after day after day. And so that's a fearful moment, clearly.
But in the moment, how many people are actually able to act on that?
Because in the end, stocks go up, as long as you're invested in good quality companies. For an advertising-free version of the show, check out patreon.com/Wall Street Wildlife. Hello and welcome to the latest edition of Wall Street Wildlife. We are pulling our hair out. The market is in turmoil and chaos. And this is such an important conversation. We're going to get this one out live to our Patreons today. The rest of you all are going to get it 7 days later because it gets nicely edited.
Yeah, when it's old and stale, the rest of you will get it. But our Patrons over at patreon.com/Wall Street Wildlife get the good stuff like hot off the presses. Badger, we had, before we start talking about the chaos and turmoil out in the world, you shared with me that you had some meaningful stuff happening over your side of the pond in your life. What's going on?
Yeah,
what happened?
Yes, I guess we both did. Mine's a kind of interesting, happy occasion tinged with some sort of interestingness. So it was my parents' 55th wedding anniversary, maybe like a week or two ago, and they had a big party for about 40 or 50 friends. My brother and I usually do like a double act speech at these kind of things. And this time we managed to ferret out a whole bunch of their old wedding photos. So these are like stills from 55 years ago. And we got the wedding video, which is like really poor quality, like cine camera style footage. You can barely see it. And it was restored like 10 years ago, but they just couldn't do a very good job with the quality of the footage. Over the last couple of weeks, I used a couple of different AI tools to restore the footage. Well, actually, more importantly, to take the stills, tidy them up, and create, bring some of the still photos to life with the power of AI. And it was really interesting. Like, I feel like I've played with that 5 or 6 of these tools now. The one I really got a lot of value out was Kling.ai, Kling. But like the best tools change almost every day. So like do your own research. It was quite an emotional end to the speech. We had a lot of bringing like their lives to life from these still images. And it kind of the video closed with both of my parents' mothers, because it was like Mother's Day a few weeks ago. They're the dearly departed. I don't have any grandparents kicking around anymore. But like probably the nicest video was my mum's mum kind of waving goodbye at the end. And it looked beautiful. It looked super authentic. It's just like her in her garden as the AI camera kind of rotates around her, and the whole room fell apart into tears. And it just made me think, it was really quite a beautiful thing. Wouldn't be meaningful to anybody else, only to the family really, and to like friends that knew my grandmother. But to be able to create this amazing emotional moment with technology, and it just made me think about a few different things really. Like this is incredible storytelling tools now, like with a bit of video editing, which I'm pretty proficient in, even though happily, thanks to our Patreons, outsource the video editing for the podcast. But I kind of know how to use these tools. And now taking like the output of AI, which, I've created like a whole bunch of 5 and 10 second clips. You got to use video editing. You've got to chop out bits, and sometimes like my mum and dad were at the aisle. It was like a picture of the the actual the main piece of the wedding ceremony, and I animated that with AI. And as my dad kind of lifts the veil off, it looks like my mum is marrying like another woman, because AI has kind of reimagined the back of my dad's head, because he's got kind of long hair in the early 70s. So yeah, you got to trim and be artful, but but you can create some really incredible like bringing memories to life. And I might loop back on this later as well in the conversation, because I think there's also an interesting, well, let's just say it now. There's an interesting kind of humorous slash bad element here, because I was thinking, well, like if anyone could get a picture of my granny and they either want to sell me something or they want to scam me, or suddenly it's quite easy to take these tools and someone else could create my wee nanny sitting there trying to sell me whatever like latest crypto scam it might be, and I might be more inclined to fall for it. Like, who owns that imagery?
I just saw the path to my future riches. Come up with my latest crypto scheme, and then send Badger a couple of prime chosen emotional. Yeah, right on. So, you know, I haven't seen what you're talking about exactly. I could imagine it though. On Apple, there's the ability to, I guess, I don't know if it's on Apple or Android both, but each photo that you take, it's actually recording something like 8 seconds or however long you're looking at it.
Yeah.
So some of them have that live thing where when it first looks like a still photo, but when you click on it, it kind of has a little movement captured. If you press on it long enough, it makes a sticker.
Mhm.
You can make a sticker out of it. So I have a photo like that of my better half kind of sitting with Bunk, my dog. But then when you click on it, you could see she's rubbing his belly and he's kind of, comes to life. And it's always there in my sticker file. Makes a huge difference. Like if the impact, the heart thing, like, from still to live, I imagine what you experienced is just magnitudes of degrees more powerful than.
I guess so. Yeah, yeah. But you sent me also quite a nice photo just yesterday. So do you want to tell us a little bit about that?
Yeah. So our listeners know that one of my closest friends died at age 46 a couple of weeks ago, and I went to the funeral service this weekend. And this is all going to be cliched stuff, but as I spoke in his memory, what I spoke about was that he had a really amazing gift of sincerely reaching out to people, to me specifically. That's all I could speak about over decades of our life together, from when we were 10 years old to now. And that willingness to connect, that willingness to say, hey, how are you? It's been 5 months since we last talked, is one of the most precious things in life. And he died in his sleep, basically. I mean, not, there was no warning, there was nothing. You just didn't wake up one day. And in as much as death is painful, remembering how important it is to care about one another in each moment, because we don't know how many we have left. And that all this money business, from our perspective, I think I speak for both of us, is to make more of those moments available to us
Right.
so that we spend more time with people we care and love about. We take more trips. We can take more time of our day, because that's what life is. Money is just an imaginary tool for, I mean, past a certain kind of survival point. So I had my heart felt full. It felt not so much. I mean, there's the loss element, but the memories and the care that I was able to remember that went into our friendship
Yeah.
was a real gift. So
Yeah. We've all got to prioritize the things. We've got to figure out what's most important to us, and then try and create a life where we can prioritize those things for good or for bad.
so Badger, shall we talk about how we're going to make more money so we have more love in our lives?
I mean, I don't know you. I'm sort of marking the funeral of my portfolio right now. I don't think AI is going to bring it back to life.
Yeah. Although it's 9:19 on Monday morning right now, futures opened up before going to bed. I saw that Japan's market was crashing and Europe's market was down significantly, and US futures started deep in the red. Right now, I'm looking at my portfolio, and everything is up massively green.
Oh, is it?
So yeah, just in the last, I don't know, 5 minutes. So I don't know what. So basically, I don't know what I'm. Right. And actually, before going to bed, I stupidly opened my mouth and said, "Uh-oh, looks like we're going to have another major catastrophic thing." And then my better half started panicking, saying things like, "Oh shit, what about my pension? What about 401ks?" And so I tried to walk back my stupid comment before bed and saying, "Okay, look, in the end, we just don't know. Maybe maybe the market's going to end up massively green." Of course, I didn't believe that because but here we are. Here we are, right? So who knows how long this will last, right? Obviously. So I thought I kind of suggested that we spend this episode, do it real kind of live, send it out to our patrons, shortly after we finish talking, because these are the moments that really can make one's investing returns terrific or completely destroy your portfolio, or something somewhere in the middle. Let's start maybe by recapping what you've read about the tariff stuff over the weekend. I'll tell you what I've seen, with the caveat, of course, that my mind was sort of elsewhere this particular weekend, so maybe I'm not as informed as I could be. How are you sensing things? What do you see out is happening out there?
Yeah, I just don't know. So I wrote an article, a special report for Wall Street Wildlife Patreons, and I published like an excerpt of that to Twitter on Friday, I think, because we were getting questions from our Patreons on the community, like, what's going on? What can we do about it? I honestly don't know. Like, I'm not an economist. I wouldn't dare try and forecast what's going on in like the White House and what the discussions are between like the Treasury Secretary and the Fed and Trump and like various other power brokers. And I've tried to focus my own thinking more on like the stuff I can control. And the things I can control are like my reaction to the situation, and then my investment decisions, and kind of where I kind of invest my mental energy. And I think so. Let me recap a little bit from this article I put out on Friday, because like the act of writing something like this helps you kind of catalyze your own thoughts. And I wrote a whole load about why I thought stuff was going on, and I'm just like, I'm not an expert on this, and I just threw away like a whole bunch. I do think there is a plan here, and I do think the US, like what's happening, it's easy to look at it and go, this is a complete disaster, a debacle, and like serious mistakes have been made. Like that might be true, I don't know, but I think there is a rationale. And if something big and cataclysmic was not almost done deliberately now, and it happens to have been through like the mechanism of tariffs, then probably something much worse would happen at some unknown point in the future because of like the debt crisis that the US is in. So I'm not like, I don't hate this situation. I think this is actually possibly for the best, but it could go disastrously wrong. Like I'm not an expert. Like there's a very narrow course that has to be walked by the administration here, to kind of bring the world out the other side cleanly. And I don't know if we'll be successful in doing that. But putting all that aside, like what are the things I do know? I do know that in the short term, it's going to be freaking messy, and I'm not going to make any reliable predictions about which way the stock market's going to go. I'm shocked you said the market was up big this morning. I didn't expect that. I haven't looked, because I kind of stopped looking at my portfolio a little bit as best I can, because I'm trying to minimize my own volatility. So I know the short term is going to be chaos and confusion and impossible to predict. I also know the long term, in the long term, which could be 8 to 10 years, stocks will be higher than they were like on the 1st of April, before the chaos kind of hit Liberation Day. And so I think the bit where I'm trying to make some rational decisions is more the medium term. Like, how should I structure my portfolio to take advantage of where I think the sectors I like, which are mostly like tech and med tech and AI and fintech, those kind of sectors, how should I position my portfolio to take advantage of there over the, let's say, the 2 to 5 year time frame, that kind of ballpark? That's what I consider to be the medium term. Maybe like 1 year to 3 years, like there's somewhere some mishmash there. And I do have some thoughts on like what the medium term could look like, but let me give you some airtime first as well.
Okay, right. We'll get into some specifics of specific companies, and I think our approaches in this moment are a little different. I want to zoom way out and say I don't see capitalism itself ending well. So we've tried two approaches. We've tried the communist approach, that was absolutely disastrous. The capitalistic approach, we could see the cracks widening. Just they keep widening and widening between the people that have the capital and the people that don't. And my own crystal ball says that at some point, but this point might be 5 years, 10 years, 20 years, 50 years, 100 years from now, at which point it's not necessarily relevant for us, but for our future generations, it will be. Something needs to break where this system needs to be completely not completely. It has to evolve into some new thing that humans have not yet exactly figured out, or the people with power and capital have to figure out how to distribute it more equally. Usually, right, between, if I think of capitalism and communism as the extreme poles, right, the truth or the best system will be somewhere in the middle, and we haven't attained that. So in these moments, I don't think this is, I'll be shocked if this is actually the beginning of the, call it, great capitulation. Doesn't feel like it to me. This feels to me like another moment in which we do what we've done for the last many decades, which is kick the can down the road and say let the future generations sort it out. And so I kind of think what will ultimately happen is some version of more quantitative easing. That's kind of what Trump wants. You want to lower the rates. There's going to be more money printing, and it'll probably reignite the cycle one more time or two more times to the upside, but with greater and greater pressure on the people that don't have assets. So the people that have equities, those will go up and assets will go up. We've seen the cycle play out so many times already. It's just that I guess the inflationary pressures on the people who have the least or the least room to breathe get squeezed more and more and more. That's kind of my prediction of sorts on a great big meta level. It's not great now, but we'll repeat what we've done. The specific thing I want to say is that Trump, the move here is obviously what you would call a hard nosed negotiation, like a negotiation from like with a club, and you basically trying to bring the world to its knees, and a lot of assumptions are being brought to the table. I'm not an expert negotiator, so I don't, nor game theory. I don't know how the game theory stuff plays out. I don't know if we even need game theory stuff, right? But we know that if this negotiator comes to the table and says, "Do this or else," right, or else everybody's economy is going to melt down, then I really don't know in terms of probability whether this is smart or whether this is kind of has an obvious outcome, in the sense that if there is not much choice, then why wouldn't the world kind of bend so to the will of the one with the club? It doesn't seem obviously like a sustainable situation. Let me backtrack and say the great fear the world has now is that this will be a global, like, escalating trade war that just continues to escalate and therefore decimate economies and bring a global recession into being, right?
Yeah.
The But if the strong arm negotiation tactic works, or works enough, then it's as you said, right? Maybe this moment needed this kind of like brutal realignment somehow, and people weren't going to do it out of their own goodwill, but given no choice, so to speak, or little choice, maybe this will be for the best. The one thing that I wonder about in terms of the US is I buy actually the need to bring back significant manufacturing to the US. I'm all for that because it creates jobs and builds infrastructure and all that. But some of the stuff I read, Luke, suggests that bringing manufacturing back is not an overnight thing,
Yeah, of course.
right?
Yeah.
You're not just going to revitalize uh, the whole foundation on which found the whole build. I mean, how long did China have to establish its sort of manufacturing dominance? We're talking about like 5-year blocks minimum, right? 5-10 year blocks. And
And
so what might happen from this tactic to when the manufacturing stuff might actually show up, it might be, we're talking years for sure.
if it even really happens, because like I saw an interesting opinion, like why would a company invest like a ton of capex in building factories and like training people and like getting their domestic manufacturing set up if like the economics of trade makes sense? There's a reason why, say, Vietnam is a net exporter, because they have like lower costs of labor. And so, these are not jobs that, there are certain things you cannot produce cost effectively in North America. And so if you kind of, you can't force, but if you were to try and create a whole bunch of artificial incentives to get that manufacturing created in North America, maybe you made it make economic sense. Well, like Trump isn't going to be around forever, even if he manages to get a third term, right? This, whatever incentives are put in place could easily just get rolled back again. And then you're back to the baseline of, well, it just makes economic sense if there were no like artificial price inflationary type things happening. It makes economic sense to develop certain kinds of materials or textiles or outputs in different parts of the world that have like certain advantages because of proximity of raw materials or the type of labor or the skills that are available. And so, what would companies invest in building that manufacturing capability if it suddenly becomes like a white elephant at the end of the Republican term? I don't know.
God, I even hate complicating an already immensely complicated picture, which obviously no one really knows the outcome of. But then I think about Tesla's AI robots, and what if we're actually entering on the verge of some completely new paradigm
Exactly.
that, right, that completely changes the world, that's just never happened before, like the steam engine or the printing press or whatever. And that somehow, I mean, maybe the way out of this is somehow that stuff is close enough that if you have robots building stuff and you have Elon who has the ear of basically the entire world and country, and we start seeing this stuff, maybe manufacturing is somehow saved, or it's just a whole different beast at this point in time, and so AI to the rescue. I
Totally
don't know.
agree. Totally agree. So that's been like the focus of my little bits of research over the last 72 hours, just starting to look at companies that are in manufacturing automation. And it may not even be like the Elon style Optimus robots. It might just be, highly automated production lines and controllers and things like NVIDIA Omniverse, like other partners of them that are in that space, like anybody who's working in an area that can, like, what's the Elon term? Like, build the machine that builds the machine. If you can do that much faster and more optimally, and a small number of humans in like an oversight role can manage like thousands of like bits of technology to create a different kind of manufacturing that's far less human intensive. I totally agree. That makes a lot of sense.
Yeah, so I guess what's the takeaway? I'm sitting at the edge of my seat wondering right now that I really have one question. I'm going to repeat myself. I wonder if this is the moment for this kind of hardline negotiation tactic. And I can't predict whether it will be effective or not, but I think there's a chance it might be. And a chance, because, well, if it's not, then we're seriously in a big mess. So maybe, I guess, I don't know if this is game theory stuff, but everyone's going to do probably what's in their own self-interest, and if their own self-interest is to negotiate with the bully, then they'll do it, right?
Yeah, who knows? Who knows? Like we've already seen some reciprocal tariffs getting announced by China. The, the US kind of has the power here because they do have a massive trade deficit with a lot of these countries. The countries that are hit the hardest, like China, are because there is a trade deficit, i.e., the US imports more Chinese goods than stuff it exports to China. So if you're like the buyer, essentially, in this, it's a highly simplified version of this relationship, well, you potentially have quite a lot of power.
Yeah, I think China is the wild card that's separate from the rest of the world,
Sure.
not least because of their now amazing manufacturing capacities, and they're good at playing the long game.
Yeah.
The rest of the world, I think, my guess is it will more than likely negotiate something.
Yeah.
Just right, much less leverage. Uh, but yes, okay.
Wall Street Wildlife is brought to you by the Chit Chat Stocks podcast. My name is Ryan.
And my name is Brett.
And we're the hosts of the show.
On Chit Chat Stocks, we are constantly researching new stocks from high flyers to undiscovered small caps, diving deep into business models, debating competitive advantages, dissecting valuations, and we have a fun time while doing it.
Supercharge your investing research and start listening to the podcast today. You can follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts. Follow the show so you never miss an episode. That is the Chit Chat Stocks podcast.
Like the bit I said where I don't feel like I have any expertise and I don't feel like I can make predictions. Should we try and bring it back to the stuff that we can control? And like, if you are an investor, how should you be thinking about this stuff?
Yeah, I think that's the most practical stuff.
Mm-hmm.
Let's start with the emotional bit first. And hopefully, right, if our patrons are listening to this today, then I approach moments like this now at this point knowing that this too shall pass, even though it doesn't feel like it in this moment. And there's always a way to make money in the market. So if you're not making money in the market, that's because your strategy was not optimal for the moment. And that's not to say, not to blame anybody, but it's, it's always possible to do well. And in moments of volatility, I think you said it best. I think on our Patreon that when everybody's panicking, everything is being sold indiscriminately. The baby out with the bathwater cliche. So and I accede that that's true. So I think my job first is just don't panic and see volatility as the way that alpha increases. As long as you then do the work, and as per our conversation later in the show, find what principles, find what areas you want to look at, and start investigating, not out of panic, but out of deliberate consideration. And we'll talk about the specifics. But there's no I want to say there's no reason to panic. No, there is a reason to panic when you're losing a lot of money and you're losing, you're seeing the value of your assets drop. That is panic inducing. So let's not be cute and say there's no reason to panic. But wiser is the actionable stuff that when you don't lose your head out of the panic, you can take advantage of this stuff.
Yeah, maybe we should distinguish between like fear and panic, because I think it's natural to be fearful at times like this. Like literally every day for several days, like my portfolio has been down like way more than my annual salary ever was, and that's like day after day after day. And so that's a fearful moment, clearly. But if you can channel that fear into like, I've got this, I had a plan for this, I'm ready for it, I know I'm going to respond to this, not react to it, then it doesn't become panic. It becomes potentially opportunity. And if nothing else, it becomes, okay, I'm just going to like do nothing and like cling on for dear life. You know, maybe that's your response to it. And that's actually a pretty reasonable response. The only way you really get in trouble is you react and then you make a bad decision, which might be selling something. It might be like panic buying stuff that you think is going down, and you end up with your money invested in like places that don't necessarily make sense for the time.
Yeah, right. And caveat here is neither you nor I have a crystal ball. So the best we can do, and what we'll hope to do, I guess, with the remainder of the show, is explain why we think our path is a wise course, open to critique, and then we'll see what the future holds, right? If we knew what how things would unfold, this wouldn't be much of a problem. But the value of a conversation like this is poking holes, right? And it's to be open to critique and feedback. So you want to talk about some specifics, like what you're thinking about of buying or not buying or holding out? I know on our Patreon, you have not made any purchases post the beginning of the sell-off.
Correct. I mean, just to acknowledge it, I did the one thing I said I was on Patreon I was going to do, which I did this morning because it's the new tax year in the UK, is I diversified about a third of my Bitcoin into Chainlink. So now I'm probably overall sort of 2/3 Bitcoin, 1/3 Chainlink in my, but overall that's like a small proportion of the overall portfolio. But I said I'd do that because I just wanted to do that. And I can realize like my capital gains allowance for the new tax year by doing some of that. So that's a good thing to do. I have a whole bunch of stuff that I shared on Patreon in the Badger and Monkey Trades channel, which is open to our dolphins and above. And I haven't acted on any of those yet, but I'm happy to share on the pod now because I've shared it already a few days ago. Like the companies I'm thinking about and how I'm like, I don't do like, I suppose I'm going to say stuff that I might regret because I don't like having like price targets and, like triggers to act. I'd rather more have a plan and then like add to my favorite companies at decent value points, but do that kind of slowly. But so let me show you something. So here is my whole portfolio, and I've got a couple of lenses over this. So the first big column with the pretty colors is like a reverse DCF, discounted cash flow. So this is actually based on valuations on Friday, whatever that was, the 4th of April. So already like a little bit out of date.
Actually, Badger, if I may just interrupt, not everyone really, I think, has a good feel for why free cash flow is the metric that you choose or why it's such an important metric. Do you want to say a little something about what it means in layman's terms?
Yeah, and I think it's that's a good idea. And I think it's even more important at times like this when we might be falling into a recession. So, and I don't know if we will, caveat, but we might. Like if you run a company, like you do sales and you take in revenue, and then you have to like maybe for every widget you sell, you have like some costs of goods sold. Like maybe we're selling mugs and it costs me like, I don't know, $3 to make a mug, but I sell the mug for $5. So there's like my gross profit is like the $2 per mug. And then after that, I've got all my operational costs. So it might be like the my head office and my sales and marketing people, and like a whole bunch of other costs to do with like running the firm. That's like eventually I get down to like my operating profit. So, and there's a bunch of other stuff around like depreciation and taxes and stuff like that. But essentially, like in that waterfall of money comes in and then how much money I have left over as the board of the company to decide what to do with, for sort of slightly complex reasons, like somewhere in that waterfall towards the end, there's what's known as the free cash flow. So this is like you've essentially run your business and you've built like your factories and your capex and you've paid your people and you're manufacturing and you're selling your stuff. Free cash flow is the money you have left over that you can decide what to do with. You might do a buyback and buy back some stock. You might pay a dividend. You might invest in maybe acquiring a competitor or entering a new market, or maybe you build like another factory. It's like the free money that the board can decide how it's going to play it. And ideally, a company is generating lots and lots of free cash flow, and it makes it agile, and it's like a truly profitable company. And it gives the company like optionality. Like a well-run company with lots of free cash flow is fantastic. And it's particularly fantastic if we are in like recessionary times. I don't know which way interest rates are going. They were coming down. Hopefully the actions that have just been taken are going to bring interest rates down further, which will support growth stocks. But if your interest rates go up again, like if companies have net debt, then their debt's going to cost them more to like refinance and to maybe raise new money. So in a recessionary environment, it could be quite painful if you're essentially not, I'm just going to shortcut and say like not profitable if you're not generating free cash flow, because you might have to go and borrow money as opposed to your business generates money, and then you can kind of grow the business and do smart things and maybe be predatory on your weaker competitors who don't have free cash flow. So I really like free cash flow, particularly at times like this, because essentially it makes the company self-sufficient.
Great. And I want to add one nuance. Often you'll see people talking about operating cash flow as well.
Okay.
So there's free cash flow and operating cash flow. And I think of it as using a water metaphor. That operating cash flow is, in a sense, when you turn on water and you have like a bathtub underneath it. If your business is healthy, then the water starts rising, right? And so it shows you basically how much money your business is making just by doing what it does, by turning on the faucets, right? But then the water just sits there, right? So you want to use that water for something, and investing into your own business, capex, might be one of those things, right? You might need to, right? If you're in a cutthroat environment, you don't really have a choice but to buy more plants or hire more people, right? So free cash flow is how much water you have left over after you've done what your business needs to grow. And often I think of that as the money going back into the pockets of investors, like dividends and stuff like that. So both are really important to measure the health of the business.
Yeah.
Free cash flow is just like you were saying, you taking the water from the tub and then drinking it. So anyway.
Yeah. Great. Good.
Okay.
So it's a useful metric. Let's go back and look at this graphic of my portfolio. So that colorful column, it's a reverse discounted cash flow estimate. Like these are all just wild guesstimates. And a reverse DCF is essentially based on the company's share price today and a few other metrics like cash flow and number of shares and market cap. What growth does the market expect from that company? And you can kind of do like a reverse engineered version of a valuation where you say, okay, so I don't know, Tesla is like the top of my list. The valuation on Friday, the 4th of April, based on my assumptions, the market expected $40 3.75% growth year over year in Tesla's free cash flow for at least the next 10 years. And then you can ask yourself, does that seem reasonable? And that probably does not seem reasonable for a company like Tesla, for it to grow free cash flow almost like for over 40% year after year after year. So then in my mind, that would be like expensive. It's an expensive lot. And the market seems to agree for lots of other reasons, which like Tesla's valuation has come cratering down. So I've got a couple of other columns on here. So this is really bad quality shortcut analysis. But let me just share what my thinking is here for your opinion, and feel free to throw slings and arrows at it. So forgetting the reverse DCF, like if I just pull the price to free cash flow on a trailing basis, so i.e., how much, let's stick with Tesla, how much free cash flow did Tesla actually generate in the last 12 months? That's what trailing means. And then, so the current market cap of Tesla is about 236 times that number. So, if nothing else, you could kind of interpret that as saying, if you were a Tesla investor for 236 years, it would eventually generate enough free cash flow over that period to like cover the value of the entire company. So that's a big number, 200 times free cash flow. And there's lots of reasons why Tesla might be a bad example for this, because it may probably not optimize for free cash flow right now because they're spending a ton of money on building like gigafactories and other stuff. But we're just giving like an example. Now, the last time, here's my really bad shortcut analysis. The last time we were super pessimistic about growth stocks was kind of 2022, 2023. Like 2020 and 2021, growth stocks went on a charge. 2020, end of 2021, the ass fell out of the market. Everyone suddenly panicked and went risk off, and growth stocks fell for the floor. So I've literally, in fact, let me show you what I've done by doing a screen share of my favorite portfolio charting tool, FinChat. There we go. So I have literally gone through a bunch of my key holdings, and here's one, which is NVIDIA, this particular one. And I'm just taking a look. This is going to seem so dumb. Here's NVIDIA's price to free cash flow over the last couple of years. And in FinChat, you can change like the amount of time, but I was mostly interested in that 2022 period. And I've just eyeballed it and gone, okay, what was the peak of pessimism for NVIDIA stock on a free cash flow basis? And you can't use this for everything, but I think NVIDIA you probably can use free cash flow. And it was about 45 times free cash flow, which was kind of October 2022. So then I'm just gone through like a bunch of my holdings and said, okay, if NVIDIA at the last peak of pessimism in 2022 was about 45 times free cash flow, like how does today's valuation compare with that? And if we go back to my valuation graphic, well, NVIDIA is what was trading on Friday at 44 times free cash flow. Actually, if we look at it today, it looks like it's 38 times free cash flow. So actually, on a free cash flow basis, NVIDIA now seems to be cheaper than the last time we were pessimistic about stocks. So massive shortcut, that might be a company I want to think about adding some new money to. And I've done that for probably half of my holdings where I think they might be interesting investment ideas right now. And going back to the valuation graphic, that's what that right-hand column is. Stuff I've marked as now, essentially very hand-wavy, is ballpark, possibly decent value now based on where its free cash flow was last time we were pessimistic about it. And then some things still have a heck of a way to fall. And maybe to pick on one of those in particular, Axon Enterprise. I've loved that stock for some time. It's part of a bet you and I have, Axon versus EOS. Even on Friday, with like cratering of Axon's value, it's still trading at 124 times free cash flow. And last time we were pessimistic about it, it got down to like 60 something times free cash flow. So that's still arguably quite an expensive stock. But some stuff potentially is looking a little cheaper, like NVIDIA, maybe like Mercado Libre, maybe Amazon is getting there. So these are this is the kind of analysis I'm doing right now, just to try and get a feel for like where everything is in my portfolio.
Right. I love this method. At least it gives you some comparisons, right? So it's not in the vacuum. The only pushback I would give is, well, one, you admitted it yourself that you have to take all of these models with 20 pounds of salt, because a tiny adjustment to whatever assumption changes the numbers drastically. But in my experience with previous major market corrections, things can always go way lower than we think.
Yeah.
So the multiples at some point just start, you think it's cheap now or fairly priced now, but when the system corrects, the baby with the bathwater thing happens. So I'm looking at even the companies that you have marked as now, good to go now. I'm like, yeah, tempting, but could it be even 50% lower than this? Of course.
Totally. Of course. Yeah. Yeah. But then the other thing to remember, because this is all in the context of like, what does the world look like now? Like if we stuck with NVIDIA, the world is quite a different place today than it was in 2022 when we were last pessimistic about NVIDIA. And arguably there is like much clearer pathway to huge demand. So these companies are not the same companies. Like what was NVIDIA's valuation like in 2022, right? It was probably a couple of $100 billion. Now it's like multi-trillion dollars. So yeah, you got to look at all of this stuff together and just kind of, that's the art of investing. So what I'm trying to do is just have a few data points so that I can sleep on each night as I try and fathom out whether it's time to start buying some of these stocks now.
And so it's interesting for me when I talk about my strategy, which is quite different from this. I have almost, I don't have any interest. I have very little interest in this moment to buy a company like Axon or CrowdStrike or Amazon,
Yeah.
for the reason I just mentioned. If I'm right, they're going to be way cheaper. If I'm wrong, then I have my own strategy to fall back on. But I am interested in, well, maybe at the extremes. For example, Mercado Libre, because it's so relatively cheap, meaning based on the assumed discount rate, growth rate of what, 3%. So the assumptions are just really tempting. But it's the companies that like NVIDIA and Tesla that I still remain ambivalently intrigued by, because the world, if the paradigm shift is happening the way we think, and based on like the latest NVIDIA conference where Jensen was talking about just how unabated the demand remains and the increased power of everything, right? The whole paradigm stuff shift is not slowing down. And so I guess I'm saying I'm putting narrative first
Yep.
in my decision making based on your strategy. So I'm staying away from the ones that are still pricey because they could fall more, but the ones that are carrying the world on their back, I'm more tempted by those.
Can you give us any examples?
I was actually debating this morning using the remaining 50 bananas I have in the King of the Jungle portfolio to buy half a share of NVIDIA. Because pre-market it was down to, well, price is arbitrary, but it was something like $88. I don't know what the market cap of $88 was, but from the peak, it reached what, 140, close to 150, right? It was close to 150 at peak. So from 150 down to 88 on a company that is as strong as ever in terms of product demand, that started feeling like we're entering solid valuation territory. So I was tempted by that, but I held off because I think I'm more tempted by my current strategy. Is there anything you want to say more about?
I think I've got some comments about your strategy because I think I'm guessing what it is. But when you tell us your specific strategy, because I know you're looking at like a different type of company at times like now.
Yeah, so when I look at my top 5 holdings of King of the Jungle, Tesla is the outlier. Actually, it's not top 5, but Tesla is in there. We already talked about Tesla, so let's leave it out.
Yep.
I'm making what feel to me like 10x bets on companies that don't yet have revenue. Therefore, there's no multiple compression to be had. So it's all
We're like infinite times sales.
right. We're infinite time sales. So
Yeah.
in some ways, it's the critique to me is obvious. I mean, maybe I don't know if I want to ruin your fun and critique the strategy myself, but when you're not yet making any money, it's even more risky and dangerous, right?
Of course, yeah.
But in times like these, when I get a sense that the multiples could continue contracting and who knows how much further, whereas the narrative piece of things, to me, as long as the company executes, if those remain the same and the companies I'm looking at are not really affected by the tariffs, but the price is dropping anyway,
Mhm.
I sense that there's a widening gap of disconnect between the future value of this company and the market throwing everything out indiscriminately. And so so my big let me walk step by step the 4 main ones that I added to recently.
Okay.
Once the market correction started, EOS, my top holding, was actually up for the week. So, as one minor case point, the market looked at its narrative and said, because it's domestic made and because there's such increasing need for the product, we're not going to sell off like we're selling all the other companies. And today it's up a little bit at the moment. So that's sort of like no money yet, but the narrative is great. Same thing for ASTS, where it's all about the execution of the launches but the potential worth of this company is so much higher than its current valuation, and everything is actually accelerating in its favor in terms of how they're executing the contracts and all of that. So it seems like another case where whether the price goes up or down has nothing to do with the tariffs. And I'm actually excited that the price is going down because I wanted way more shares. So my investment strategy here actually got better, more favorable. The one that I'm most prepared to talk about today, this is the one that I think I'm most open to critique, but it's the one I've given the most thought to. Let me spell out some specifics about this company, Luke, just so we're not talking about a vacuum about some, random biotech. Relay Therapeutics basically is holding what could be a potentially really valuable asset that helps with breast cancer. Okay, so we know breast cancer is a major, major thing in market and it's life or death. We also know tariffs have nothing to do with biotech stuff, other than, I guess, macro situation and like how hard it is to get capital. But the company will or won't make it tariff based on its data. So right now, Relay Therapeutics is down to something like a $330 market cap. It has $780 million on its balance sheet. So you're getting, so basically the market is saying they're going to burn through their cash faster than they can make it down the road. That's why that's kind of the market's view. The specific I wanted to call out is that there's something in this field called the progression-free survival rate. So when you give somebody a cancer drug and you run a data trial on it, you get to see from the time patients take this drug, how much time passes where the disease doesn't get any worse. The current top of the line treatment is a company called TrueCap. I think I'm pronouncing that right, where the PFS, progression-free survival rate, is 5.5 months. Okay. The last data that Relay Therapeutics got from their data trials was their molecule is at 11.4 months. So double. It's twice as good as the current best competitor. The FDA has been known to even say, okay, we have enough data, stop it, you're good to go, when it's basically 2x, around 2x. So Relay Therapeutics basically has to get through one more clinical trial, and then it might be enough for the FDA to say you're good to go. And that's what it's looking like right now, 11.4 versus 5.5. Okay. Based on the numbers reduced, based on meaning on TruePak's current sales, we know that the market cap, the value for this drug is about $5 billion, just this drug alone, versus current market valuation of 330 million. And enough cash, 780 million, to last it through sometime into 28, so 3 years from now. We also found out last week or sometime on Friday, I think, that Relay let go of 70 people, which is, sad, obviously, for its employees. But from a business standpoint, they're really managing their cash very tightly. They know the stakes, and they're just not going to lose this game, basically. Data in hand, matter of time. So with or without the tariffs, Luke, this company wasn't being measured on the tariffs at all, right? But all of a sudden, it's dropped 60%. The only problem here for Relay is what I would call cost opportunity or timing stuff. We know, investors know, that the Relay's not going to have new data for, call it, a year and change. That's not exactly right, but for simplicity's sake, right? We have more time to sit on our hands, especially before commercialization. So why would buyers step in now to buy it now, right? The answer is they're not. That's why the price keeps dropping, right? But now at some point I'm saying to myself, as somebody that recently for the King of the Jungle bought more shares, I was like, well, okay, why do I want to be the fool that's one of the few buyers when everybody else is indiscriminately selling it? And my answer, well, it's not an easy answer, but I decided, no, yeah, let me be the fool because, and this might feel ironic to you, I didn't want to necessarily market time. I basically said, I know that in 2 or 3 years, if everything basically stays the same to get to 5 billion from 300, that's now a 20x or something like that, right? So why don't I start adding to my position at these valuations that have nothing to do with the panic selling going on? And if it keeps dropping lower, I'll keep accumulating, and maybe I'll get to my retire early stack way, way earlier than I thought I would, because this is kind of a gift. So I'm sort of sitting here like saying my strategy, to maybe sum it up, is I don't want to get necessarily cute in predicting when some big buyer is going to step in, see what the biotech experts see, and start swooping it up and bidding it up again. I know the data. I trust the data. Why not now?
I think that's very fair. Yeah, I had a concern when we were chatting pre-episode about you saying you're going to power into a bunch of pre-revenue companies, but my criticism doesn't apply to this one. Once you showed me the numbers on FinChat just now, because like the problem with being a pre-revenue company is like you need money. You're like a burn rate, And the idea is, you need money, you have to raise money somehow so you can keep the company going. So eventually you can launch a product and have revenue, and then you become mature, and eventually, like one day you're Johnson and Johnson if you're like a biotech. There's only really like a couple, but there's really two main ways companies raise money. One is by issuing debt, i.e. they take out a loan. And then the other one is by issuing stock, i.e. like selling more shares into the market and raise money from investors. In like volatile, difficult, maybe recessionary times, if interest rates do start climbing back up again, like it's going to be freaking expensive for companies to issue debt, and that's going to kill like a bunch of smaller, like non-profitable, not even pre-revenue, but non-profitable companies. It's going to force those companies potentially to issue way more stock, which means that current investors get like, what's the term? Not liquidated.
Obliterated or diluted to hell.
Diluted. That's the term. Yeah, they get diluted and obliterated. So like tough times reward like the strongest and they punish the weakest. So pre-revenue companies are among the weakest like players in the space. But the reason Relay Therapeutics gets a pass on this one is they just seem to have a ton of cash. Maybe they've done the dilution already.
In fact, yeah, let me speak to that. A couple of months ago, when they got the latest batch of really good data, the stock shot up to $9 per share, and I think they issued a bunch more shares. They diluted at $7 a share.
Right.
So think about, in hindsight, we were like, damn, the dilution, right? But now, in hindsight, that's 7 versus $1.80 at the moment.
Yeah.
So that looks like genius, but management knew this was, a necessary thing. So this applies also, by the way, to ASTS because they just played this. They have such top notch management. They're sitting on about $1 billion in cash, and so basically all of these companies that I'm looking at have preventively set themselves up for success despite the tariff stuff.
Okay.
And all that I'm seeing is a widening and widening gap between what I think of as the more likely outcome and this precipitously dropping share price. So I'm trying to gobble up shit. Well, not gobble up isn't quite the right word, but I'm okay adding now, even though they could drop further.
So that's good. And I support like both of those because you're right. ASTS are also very well capitalized. Why don't we talk for a bit about like how we're playing, not even the stocks we're choosing, just how we're kind of managing our. Well, let me explain what I'm doing because maybe you're not doing the same thing. It might not apply to you. Like I got to 25% cash in my portfolio back in kind of January, February time, knowing that something was going to happen. Like I had no idea. I could never have predicted like the impact of the tariffs thing. I know Trump talked about tariffs a lot. I didn't know it's going to go like quite as badly as it has gone, but things just seemed overvalued. So when things are overvalued, I raised money and I got to 25% cash because my portfolio has been like cratering, like everything else has gone down. That cash is up to like 27% now because the cash has stayed the same. Everything else has fallen apart. So, like I said earlier, like some of the stocks I'm thinking about buying back into, but I'm going to do this incredibly slowly. So at some point I will decide to start reinvesting. That's not today. It might be tomorrow. I just don't know. Right. But I'm just going to keep an eye on where valuations are. And when I start reinvesting though, I'm going to do it super gradually. And I'm probably going to then spend a year bringing myself from 26% cash back down slowly towards maybe 15% cash, maybe 10% cash, depending on how cheap stuff looks. I'll probably never go below 10% cash because that gives me like a couple of years worth of kind of spending money to run my life. So that's my plan, like very gradual, slow reinvestment over at least a 1 year period. And I'll probably do like every quarter, I'll just kind of do a checkpoint and say, is this the right strategy? Should I change my strategy?
Yeah, and this is useful because your situation, your financial situation depends on this.
Exactly.
Whereas I think our listeners should look at what I'm doing with the King of Jungle portfolio as my best live model for how I'm thinking about this. The $200 is, to remind everyone, an arbitrary figure that's meant to signify an amount of money that I don't need to live on, that is regular coming in. I can expect another 200 next month. And if it goes to zero, I'll still be okay. All of that, all of those parameters are in place. And so far, so I kind of broke in my mind, Luke, I broke up the $200 in almost like quarter chunks, like $50, $50, $50. So I didn't spend it all at once. But then, first of the month, the money came in and we had that major drop. I think I spent about 60. Then we had another 6% drop or 5% drop. I spent another 60, say. Now I have
With jumping, because I want to make it really crystal clear. Like, you have a job, you're a professor, and you have like you are other sort of sources of income. The King of the Jungle portfolio isn't material to you, but this is like a proxy for how you're thinking about investing. And it's representative of the things you're doing in your real money portfolio, because you don't talk about your real money portfolio so much, whereas it's much more of like my focus. But
right, exactly.
so if you listen to Krzysztof and going, well, like, who cares about $200? It's not, it's $200. It's like, this is the way you're thinking about investing, and you're making kind of similar-ish moves in your real portfolio that you don't talk about.
Exactly. So to reiterate, the $200, you could add a zero to it if you want. You could take it off a zero and have it be $20. It doesn't matter, but it represents the kind of money that is not nothing, but I'm choosing basically not to market time because of the research, because on the back of my research, I have a fundamental confidence in these companies, and I'm kind of taking the almost quarter approach, right? 25% today, okay. Market dropped again, 25%, okay. Market dropped again, another 25%, and now I'm down, unfortunately, to only another whatever, $47 or something. So today I'll be looking at my shares and debate whether or not I want to add any more today or wait a little while, but I don't want to get cute because the value is very apparent to me already.
So really, really very different styles, and perhaps dictated by like how, like, the sort of meaning of the portfolio in your life. Like, if your portfolio went literally to zero and vanished, like, you're fine, you've still got an income and you've got some property and like different kinds of assets. If my portfolio vanished, I'd have to go and get a freaking job. Like, it would really change my life. So that's why we've got like these different perspectives, and it's why you can't just copy what any other investor does. You've got to look at your own portfolio and your investment decisions in the context of like your lifestyle. But I think a good guideline that you and I both adhere to, and all of our listeners should adhere to, is like, this investing money should not be money you need in the next 5 years. So if you've got an income, maybe it's not. If you don't have like a regular income, you need to have like a couple of years worth of spending money stashed away, like a bigger emergency fund in essence, so that you don't let the fear translate into panic when things like today happen.
In fact, this is so important. Anyone listening to us right now, we really want you to take this in deeply. Badger, you know the difference playing at a poker table when if you lose, you're totally fine, almost like you treat it as play money in a certain mind frame, right? Versus if you're playing as an amateur, that's kind of white knuckling it, and the last thing you want to do is lose your money. So then any good poker player sniffs the fact that you are overly tight or overly risk averse, and they'll just push you around, right? But to play real poker, you in a sense have to not have, you basically have to let go of your fear. You have to just make the best decisions that the cards and the situation tell you to make, right?
Yep.
Fear be damned, and sometimes you'll win, sometimes you'll lose, but you'll have done the process the correct way. The King of the Jungle portfolio for me is a perfect model. That's why I think it's good that we do this. I do not worry if that $200 every month I put in goes to zero, but I believe it's gonna make much more of itself. So I'm I feel almost like free to buy a company like Relay, even though nobody else wants it. So that's the other thing. Sorry, it's a little bit of a tangent, but it is in moments like this with Relay such a great test case where that contrarian thing that I often speak about, this feels like one of the best moments that it's on display. It doesn't really matter to me knowing that that there are no buyers, because I know what I know. So I mean, God, I don't know, maybe that sounds a little arrogant, but I mean, at some point the data is what the data is, and to me it's a matter of time and patience, and not, being greedy when others are fearful, blah blah blah. You hear that so much, but in the moment, how many people are actually able to act on that?
Yep. Hey, here's a kind of a tangent, but it might actually help this conversation. I have got a good friend I reconnected with recently, and she is just starting to invest. She started listening to the podcast. Alice, hi. And so we've been chatting on WhatsApp, and I'm trying to, point her at various episodes and conversations that might help her kind of get set up and get started. And Alice is like young and got an income, and like she's in a good place in life. Like she's very different to my dad and his two best mates, who I saw yesterday, and they also want to start investing. They haven't invested before, but they're in their 70s, and so it's a very different paradigm to Alice, who's like less than half their age. But all of these individuals want to get started investing. So putting their individual situations aside, like what advice would you give to a new investor? Let's say you've been listening to this podcast and you haven't done what we've been bloody telling you to do, like just get started. You still haven't got started. How would you get started today, given kind of what's happening in the market?
Are you talking about actually like things like set up your account and fund your account kind of stuff?
So we've done all that. We've done all that. You've maybe, you've got some money that you want to invest, and given and it's like Monday and stocks are up, but like Thursday and Friday stocks were down bigly. How would you play it if you're a new investor? You don't have, and I think I'm not trying to lead the witness here, but
yeah.
These individuals they will have no experience of like the kind of market conditions we're in right now.
So let me talk this through by saying the first question I think that has to be answered is you got to give each investor has to have some sort of goal line in mind, because to be 70 is different from being 20, right? But it's not foretold. It's not. I don't want to make any assumptions. Maybe somebody in their 70s needs a lot of money really quickly, or maybe they just need enough. But who am I to say? I can't judge, right? Maybe the 20-year-old. I mean, because everyone's situation is different. So I think first the answer is what is your goal? Let's call it, you want to make $10,000. You have 1,000 and you want to make 10.
Okay.
So you want a 10x, right? Or you'll be okay with just much slower rate of growth. Well, that answer is really important, because based on what I was saying today, if my best, let's say, elevator pitch, stock pitch, if you find me in an elevator and you talk about stocks, what should I buy? Right now, top of my mind is Relay, right? Because I was just spent all morning talking about it. It's not obvious to me whether I could say to the 7-year-old, invest in Relay, because, well, they don't make any money yet, and maybe the drug collapses and maybe that goes to zero. So for the 70-year-old, maybe that would be devastating. But if they've already lived a full life, right? And now this is kind of like overtime and bonus money, right? And they really want to, buy a little cottage on some little island, but there's no way that ever they're going to do that unless they kind of quote unquote win the lottery and they're willing to sort of go for it. Then I'll say, hell yeah, buy, 20% in Relay, and then buy 20% in ASTS, and but so context dependent. That's how it would start.
Yeah, I agree. That's good advice. And I think that same thing still applies. Like, don't be investing money you think you'll need in the next 5 years. If it's literally like, if you're, so there's the two parameters there, aren't there? Like, if you're young and you have like decades ahead of you, it doesn't matter what stocks do over the next couple of years, because in the end, stocks go up as long as you're invested in good quality companies.
Yes. Second. I'm sorry. Did you finish? You didn't finish it.
Okay, let me try and finish that thought. If it still makes sense, I don't know. And then the other kind of parameter is like, if you don't have decades ahead of you and you're looking to have a return over, say, at least a 5-year time frame, like you cannot be an investor if you're looking at lower than a 5-year time frame, in my opinion. Well, just make sure then that whereas the 20-year-old might have like actually put quite a lot of money in because they can withstand the volatility, if you're older and your investment horizon is shorter, just make sure it's money that if it literally, like worst case, goes to zero, it's not going to impact your lifestyle.
Correct. Let me reprise some advice we gave on our How to Get Started episode for parents and children. Listen to that again, dear listeners, if you haven't. I'm a big fan of the just get started principle, which might mean you buy, you put in some really minimal amount of money, but it's real. And then you could easily buy, let's say, something like one placeholder share of the companies that most interest you and that you've done research on, and you've looked at our portfolios and you've named, okay, you like this relay idea, and you like Axon, and Badger's now talking about Mercado Libre a lot. Actually, Mercado Libre is an outlier because the share price is so expensive, but you could mathematically finagle that. But you basically just start by buying one share as placeholder so that you literally get yourself into the game. Now you have a tiny stake and you could begin your process then, as opposed to thinking I have to wait until I have X number of dollars and only then will I start. So get in the game now, today.
Yeah, agree with that. And then maybe let's take that a bit further then. So get started. Get like a basic stake in a bunch of companies you might be interested in, because it motivates you to then do your research, which might mean like listening to this podcast week after week. It might, if ideally it means going and looking at the investor relations page for the companies, maybe watching their last earnings call, reading the slide deck, maybe starting to do some of your own research on kind of competitors and where the market's going. Like this is all it's kind of like, it sounds like work, but if you're going to be an investor, like you have to turn that stuff into the fun stuff. Like I really enjoy doing that, because you smell, if you're successful, you feel like, oh yeah, I was like outsmarted the market. Like I saw something the market didn't, like that. So that's your process. Now, I don't know if you're going to say the thing I wanted you to say, so I'm going to say it instead, and you can disagree with me if you like. So
I have something on the tip of my tongue. Are you going to say? Go ahead.
So we'll go on. No, you go first then.
The other, to me, obvious thing was in our community, we have some posts now of people talking about what 6 companies most interest you right now, right? If you could build a portfolio from scratch, and we're starting to have a conversation around that. If I'm listening to this, that's my next step, is I would go join our community, and these people who have been investing for a long time, they've already done a lot of filtering for you, and they're saying this is where you should start investigating. So out of the thousands of companies available, oh look, here's X, Y, and Z, and then you do what you were just talking about. But now you're part of a larger group and surrounded by people that all want to succeed in this way, and you're not alone, and that's going to keep you in the game longer. So
yeah, that's good. Yeah, investing is better with friends. So that, and being in different kinds of investing community, or even just chatting to other investors on, ideally not on like Instagram and Facebook and TikTok, because there's just a bunch of really shit advice on those platforms, but there is really good quality advice on X, previously known as Twitter. But if you're not, like a social media guy, just start reading like the news and filtering it skeptically and saying, are they just trying to sell newspapers, or actually they're telling me something useful? But anyway, that wasn't the thing I wanted to say, because the thing I wanted to say was, if you're getting started in a more sedate market, like, your emotions probably aren't going to be tested. But at times like now, your emotions are going to be tested, and you might feel like a schmuck because you didn't invest enough, and then suddenly stocks went up and you're like, oh, I missed out. And then you end up not investing because you're like, oh, I missed the boat. Like, shortcut, you did not miss the boat. Or you might be fearful and feel like a schmuck because you invested and then stocks went down and you're like, oh, I was too soon, or I invested too much money. So, like, it's hard. Investing is hard. And Krzysztof and I, and anybody else who's been investing, most investors who listen to this probably experienced 2022. Some of us experienced 2008, and then some, like, really grey-haired listeners might have experienced like 2001. Like, we've seen this before. And once you've got the battle scars, like, you kind of know how it plays out, and you have the confidence to watch your portfolio, like, watch its pants fall down and go, this is going to be okay. Like, I just need to stick to my process, keep checking, manage my portfolio, but let time play out. I've seen it get destroyed, and I've seen it come back to higher points again. And that's going to happen again this time, but you have the confidence of having seen the story play out. If you're a new investor today, you don't have that experience. You're just kind of relying on people telling you that. And you're right to be skeptical and say, oh, maybe these guys are just trying to, like, sell a podcast, right? They haven't really experienced this shit. So
and you talked about this on Patreon, because we're limited humans who have to respond to each daily news cycle. We think in terms of days often. The minimum, I think, quality investing block time, I would say, is 3 years. Sometimes I put a dash, but just think to yourself right now that it's April 7th, 2025. You won't really truly know whether the decision you made today, whether it was right or wrong, until 2028, give or take, right? I mean, some things might blow up before then, and so that should really change how you approach this.
Yeah, totally. That's a really good point. You don't even know if you're a good investor until many years have elapsed. Really, like a whole cycle, which is more like 7 to 10 years. You don't really know if you're beating the market or not. But anyway, there are some tactics you can use, though, even if you have zero experience, and that's to just dollar cost average. So I don't know how much money my dad and his buddies or Alice are investing, but let's say you're investing, I don't know, well, the UK ISA allowance is £20,000. So let's say they're all investing half of that. I'm just going to make a number up, 10 grand each, right? It's volatile times. You don't have any experience of this stuff. You pick out your 10 favorite companies. You get started, as Krzysztof says, you just buy. I don't really like the buy one share. I know he likes that, but I might say, buy like a small but meaningful stake. So if your portfolio, say the money you're going to invest is 10 grand, maybe to get started, you might take £2,000 of that. You've got £8,000 in cash. The first, you get started by putting that £2,000, £200 into each of your 10 companies that you chose. So I'm waving my hands a bit, but something like that. And then next month, or maybe in next quarter, depending on how kind of the world is going, invest another 2,000, and then give it another couple of months and invest another 2,000, and then just spread it out over 6 months, a year, like a period of time that means that if stocks go down, in a few months' time when you buy again, if stocks have gone down lower, like, you're buying at a cheaper valuation, so that's good. Like, you're getting better value for the next tranche of money. And if stocks has gone up, well, that's good as well, because the stuff you invested before has gone up, and now you're like, oh, I can see the journey working. So eventually what you're doing is, by buying over a longer period, is you're reducing some of that volatility, and you're kind of averaging the price of the stuff you're buying.
Bingo. So Badger, I think we've talked to we're blue in the face, right?
Yeah.
The markets, what's the TLDR? Nobody knows how this is going to turn out. Nobody knows what tomorrow will bring. We do know that if you buy quality companies after having done your work and you've talked about it with your fellow jungle animals, you are putting the probabilities in your favor. And over a 3 to 5 year block of time, if you keep following the correct process with probabilities in your favor, just like in poker, the same people keep winning over and over again because it's a matter of time. And you just kind of double down right now on the virtue of patience in the case of not wanting to do too much too soon. And on the other hand, to sort of state the other side, check that risk aversion part of you that feels really scared, like a scared little bunny and wants to hide somewhere, and see if you could kind of find the heart of a lion in you after having done the work, and be willing to say, no, this is the situation, others are panicking, I'm not going to panic, and I'm going to just take a good bet, make a decent bet at this because the odds are in my favor, and repeat.
Yep. And times like these are the best times as an investor. It might feel like they're the worst times. These are the best times to be an investor. It's so counterintuitive. This is really like the investments you make when valuations are depressed. And like as I said earlier, like not everything is cheap. Some stocks I'm looking at are still overvalued. I certainly think some of my holdings are going to get much uglier before they get better. But as things get cheaper, the investment decisions, when you start topping stuff up, those are the ones that really make a difference when the cycle turns and growth comes back, which might be next year, or it might not be for 10 years. Right. So, got to
Right on.
Yeah.
Yeah. And so I guess, yeah, that's plenty of jungle wisdom for today, right?
Yeah.
The market right now, an hour and a half after we started, is now more mixed. So I think we're back in the red. So God only knows what's happened in the world in the hour we were recording this. But we'll see you on the chat, right? We'll see all our patrons in our chat lounge. Please check us out at Wall Street Wildlife. I'm sorry, patreon.com/Wall Street Wildlife. Say hello. Tell us what you're worried about, what you're doing, and we're in it together.
And we did both look at an extract from finchat.io earlier this episode. That is our favorite portfolio tracking, like stock analysis tool. You can get in normal times. There's a discount, and I know that we're recording on the 7th. I think when this episode goes live is going to be the 15th, and I think they may have announced their quite an exciting discount. If you go to finchat.io/wildlife, at any other time in the year, you're going to get a 15% discount off of a paid plan with FinChat. I mean, you can just go check it out. Even the free version is really, really good. But you'll get a discount of 15%. I think they're planning to do a 25% discount, and that might be live right now when you're hearing this episode, if it's mid-April. So go check out finchat.io/wildlife. And if you see that 25% there, like, it's a good time to click the buy button.
Are you ready to become a beast of an investor?
Don't get scared. Your journey starts here.
Rawr.
A reminder that the people on this program may hold positions in the companies that are mentioned. Buying and selling stock carries financial risk, which could include loss of capital. The views in this program should not be taken as personalized advice. Before acting on any of the information provided, listeners are encouraged to consult a financial or tax professional.